Target's boom may be over, but its burst has only just begun. The retailer saw sales skyrocketing during the pandemic, but everything came crashing down when inventory imbalances plunged profits by over 90% in a single quarter. Its supply chain problems continue to spark major disruptions in its operations and cause frustration among shoppers who are tired to see empty shelves at Target stores. Several signs of distress are indicating that the company's financial health is rapidly deteriorating, and believe it or not, the megachain is falling behind smaller competitors in many categories right now. Today, we've compiled several facts that reveal how poor Target's financial situation really is and expose the factors threatening to dismantle the retailer's business in 2023. But before moving on, we kindly ask you to support our work with a thumbs up and don't forget to subscribe. 1. $25 billion have been wiped out from Target's market cap in 2022. The past 12 months haven't been easy for the big box store chain. Its stock fell for 5 consecutive quarters, erasing $25 billion in market value as investors digested the retail giant's alarming earnings results, which revealed that annual revenue was well below expectations due to a series of unresolved problems on its internal operations and supply chains. That was the biggest yearly loss the retailer has ever faced. 2. During the busiest shopping season of the year, Target's profits plunged by 43%. No other big retailer had a harder 2022 than Target. After experiencing a 52% profit loss in the first quarter, a 90% collapse in the second, and a 53% in the third, the fourth quarter, which typically helps retailers offset losses faced throughout the year, only aggravated the woes of the big box chain. During last year's peak shopping season, Target's profits sunk by 43%. That is the highest amount recorded amongst all U.S. retailers. The company ended the year on a very bad note, and its start to 2023 has been incredibly turbulent. 3. Target stock suffered a dramatic beating after consumer demand faced a precipitous decline. When the big box chain reported its unexpected drop in holiday quarter sales in January, pointing to dwindling consumer demand for everything from toys to computers to furniture and clothing, its shares faced the third worst single-day decline in history, only behind the 1987 Black Monday and the 25% crash that occurred after it reported a 90% profit loss on the second quarter of 2022. Shares of the big box retailer fell more than 17% on January 18th. The retail giant was hit the hardest among major retailers as its product mix weighs more towards apparel, home furnishings, and electronics, prompting it to discount heavily to clear excess inventory. But even the lower prices weren't enough to attract shoppers. It was a precipitous decline in discretionary demand, and frankly, we've seen those trends in previous quarters as well, said Christina Hennington, Target's CGO. Its reliance on consumers' discretionary purchases may cause further trouble for the chain in the months ahead. According to Statista, 2/3 of Americans plan to spend less this summer compared to the same time a year ago. 4. The retail titan's apparel business is crumbling down. Since November 2021, Target's apparel sales have been shrinking. While inventories in categories like fashion remain among 23% higher than during the same period a year ago, from March 2022 to March 2023, consumer demand fell at a 3.5% monthly basis. The company noted that U.S. consumers' willingness to spend on soft goods like clothing, footwear, and accessories almost halved since 2019. The biggest decline since at least 2013, UBS analysts revealed. Middle and lower-end consumers are starting to get squeezed by inflation, and they're beginning to cut back on non-essential items, researchers wrote, adding that the retailer needs to be cautious on the lower end of the consumer spectrum because inflation always hits the lower income cohorts hardest and first. and these results imply that's starting to happen now. 5. The big box chain lost over $664 million in the past quarter alone. For the quarter that ended on January 23rd, Target reported profits of $876 million, or $1.89 per share, marking a decline of $664 million from a year earlier, when the company registered $1.54 billion in profits, or $3.21 per share. On top of that, its gross margin rate tumbled to 21.7% compared to 26.1% 1 year earlier. The company expects adjusted earnings per share to be in a range of $7.75 to $8.75 in 2023, but analysts were expecting $9.18 according to FactSet. 6. Consumers are still complaining about empty grocery shelves at Target stores. 3 years after the pandemic, Target aisles are still looking barer than normal. Shortages of baking goods, meats, produce, dry goods, and frozen food are making customers increasingly frustrated. On social media, thousands of posts document the retailer's inventory holes. What the heck is going on at Target? Have they given up? One shopper asked on Reddit with an image of empty shelves. My local Target has looked like this recently too. I don't know what's going on, answered another. The shelves are always half empty, and if you ask a clerk for something, she may say, "I'll see," and point vaguely to 2 or 3 barren shelves down the way, the third commented. Is your Target at an all-time low right now too? Another user asked. One employee responded, "None of us have enough hours. The stores are in disarray because no one has time to pick anything up at this rate. Our fulfillment team is getting the raw end of the deal as per usual." I overheard customer service workers telling someone on the phone that fulfillment can't complete their order the same day it was ordered because they are so far behind. It's all spiraling out of control. In other words, its supply chain may be a much bigger problem than anyone imagined. Which leads us to the next topic. 7. Target's inefficiency supply chain is a $100 million problem. According to retail expert Neil Saunders, Target's messy supply chain may cost an additional $100 million for the company this year. Problems with its next-day delivery capabilities, supplier losses, expensive transportation, and clogged warehouse space are just a few of the issues plaguing the retailer supply chain right now. If the chain doesn't fix its network and improves its operations, expenses can be even greater than predicted and further damage Target's balance sheet. 8. IKEA is surpassing Target in the home goods sector. Target currently has a 9% share of the U.S. home goods market. That's a slump from the 11% it had in 2020. While sales continue to go down in this segment and inventories continue to pile on, Target isn't positioning itself to compete with other growing brands, including IKEA. The furniture maker is expanding its operations in the U.S. and revealed plans to invest $2.2 billion over the next 3 years, the most spent on one country in its 80-year history. Since 2021, Sweden-based IKEA snapped an additional 2% of the U.S. home goods market share in the brick-and-mortar segment, now at 9.3%, and it now holds a 33% share of the online market, followed closely by Amazon at 30%. With Target's dialing back on the segment and shrinking its physical footprint, it's clear that the retailer is starting to fall behind major names in the industry. 9. Target is putting entire departments on lockdown due to a shoplifting crisis. According to the company's executives, every year Target loses approximately $400 million due to shoplifting. The situation is getting so extreme that now the retailer is locking a large number of products across several departments to protect itself against thieves. Last week, the Post reported that the big box chain is putting all of its cosmetic and toiletry products on lockdown in multiple stores that have been reporting persistent cases of shrinkage, with the majority of restrictions occurring in its San Francisco locations. On Thursday, footage of a store's interior posted to TikTok showed aisle after aisle of common pharmacy store products under lock and key in the megachain. While it's common for stores to lock up small, valuable items like razors, a large quantity of inexpensive large items such as mouthwash, shampoo, and lotion were also being kept out of reach of would-be shoplifters. Like other retailers, organized retail crime is a concern across our business. We're taking proactive measures to keep our teams and guests safe while deterring and preventing theft, the Target spokesperson said in a statement. The chain also listed items like body wash and over-the-counter medication as items that are particularly attractive to shoplifters, who can often sell these stolen goods online to smaller stores. It definitely looks like desperate times are indeed leading to desperate measures. 10. The chain's grocery prices are on the rise, while other retailers try to keep prices low. Although grocers are doing what they can do to lower prices and boost sales amid a scenario of persistent inflation, Target is raising grocery prices again this year. The company is trying to compensate for the losses suffered due to shoplifting by hiking the prices of thousands of different items this summer. In February, a study by the University of Baltimore found that the same basket of everyday goods at Target, which included common items such as bananas, bone-in chicken thighs, Old Bay peanut butter, canned green beans, ground beef, milk, sugar, chips, bread, and eggs, rose by $43.54 from a year ago, and that represents a 19% increase, and largely it's surpassing the rate of inflation for the category. The company's pricing strategy may not be the best given the time being, but it is getting clear that the retailer is running out of options to keep its business afloat. 11. The retail apocalypse is forcing Target to shut down underperforming stores. This week, Target will start closing down several locations that have been coping with declining foot traffic, revenue losses, and supply chain issues. The first round of shutdowns will happen in Maryland, Minnesota, Pennsylvania, and Virginia. The decision to close our stores isn't something we take lightly, Target spokesperson Kayla Castaneda told Insider. It's an action we take only after multiple years of working to improve performance, she said. Unfortunately, hundreds of locations are reporting disappointing results, and according to Retail Dive, the second round of store closings may begin as early as July. 12. The struggling retailer must save $3 billion to balance its finances. During an investors' call, CEO Brian Cornell said that for the company to get back on its feet and recoup its pre-pandemic operating income margin rate, it needs to save roughly $3 billion to put its financial situation back in order by 2024. However, the retailer is also spending $5 billion to expand its supply chain network and digital operations and to improve its services. Although the investment may pay off in the long run, right now, that is leaving the chain at serious risk of accruing a billionaire debt just as its loan obligations, valued at $1.7 billion, mature in the next couple of months. In other words, it looks like the company is teetering on a knife's edge. 13. The Target CEO is sounding the alarm about the state of the U.S. economy. With sales slowing down at a frightening pace, Target's executives are very worried about the economic outlook for 2023. In March, CEO Brian Cornell said during an earnings call that shoppers aren't spending the typical amount of money they used to spend at Target stores over the past couple of years. That is squeezing the company's bottom line and forcing it to take a more conservative posture for the rest of the year. Consumers are feeling increased levels of stress, driven by persistently high inflation, rising interest rates, and a sense of uncertainty about their economic prospects, Cornell noted. With high rates of inflation continuing to erode their purchasing power, many consumers this year have relied on borrowing or dipping into their savings to manage their weekly budgets, the CEO continued. But for many consumers, those options are starting to run out. As a result, our customers are exhibiting increasing price sensitivity, becoming more focused on and responsive to promotions, and more hesitant to purchase at full price, he revealed. On the same note, Christina Hannington, Target's chief growth officer, pointed to 4 consecutive disappointing quarters. She stresses that it's really prudent for the retailer to make sure that it has a more conservative posture throughout the rest of 2023. 14. Executives are forecasting a dull profit growth for 2023. Last Tuesday, CEO Brian Cornell also forecasted muted profit growth for the year and warned of the need for more discounts to get rid of unwanted inventory and to rebalance the company's supply chain. Even though discounts may eventually boost Target's customer traffic, they'll likely add more pressure on its gross margins and increase its liabilities. The big box retailer warned investors that they were forced to pass on more promotions due to a constrained environment for consumer spending. We're planning cautiously given the economic challenges we anticipate this year, Cornell noted. That will mark the second straight year of major financial losses for the retailer, and it paints a very grim outlook amid the sector's ongoing crisis. 15. Wells Fargo just rated Target as a bad investment for 2023. Target is no longer an attractive investment, a Wells Fargo analyst said last month, citing a range of continued headwinds and challenges. The bank's managing director, Edward Kelly, highlighted that the retailer's outlook has deteriorated meaningfully. Our concerns include the potential for a sustained period of weakness in general merchandise, an inflection to negative traffic, a lack of visibility on the timing and magnitude of the margin recovery story, and the return of pre-COVID model scalability concerns, Kelly said. The banker is advising clients to move away from Target shares and focus on other investment opportunities in consumer staples retail brands that don't look particularly distressed to begin the year. He named Target as one of the bottom 5 retailers at risk, along with Kroger, Costco, Sprouts Farmers Markets, and United Natural Foods. If the company fails to strategize during this critical moment, we are likely to see mass store closings and widespread layoffs being announced. Never before in history, the big box chain has faced so many difficult challenges all at once. With economic indicators signaling that more volatility is coming, the retailer must position itself to fight yet another battle. If there's something that we've learned in the past few years, is that the retail apocalypse forgives no one. We've seen huge chains falling apart and disappearing from one year to the other, and if Target doesn't play catch-up soon, it may suffer from the same fate as other collapsing retailers. Thank you for watching.